And I may give it 1 or 2 more minutes. It looks like we've still got people jumping onto the WebEx here. So we'll get started here in a minute. All right, I'm going to go ahead and get started, and I've got a few introductory comments, and so that way people can continue to join before we get into the kind of the heart of the presentation. I'd like to welcome everyone to Midland Wealth Management's Mid-Year Outlook. My name is Eric Hoeineke. I'm the president of Wealth Management here at Midland. With me today virtually is Betsy Pearson, our chief investment officer, and Tracy Garst, our senior portfolio manager, and they'll be handling most of the presentation here this afternoon. As I mentioned, I just have a couple of brief comments. First of all, I want to thank everyone for joining the call and certainly thank all of our clients. Again, without your trust, none of this is possible in terms of what we do on a day-to-day basis, and we certainly appreciate that. I do have a quick announcement, I guess I'll say. Many of you may have seen that Midland Wealth Management did complete an acquisition here in the second quarter. Actually, the trust company completed an acquisition of ATG Trust Company based out of Chicago. We were very excited about that. Very excited to have that team of talented, experienced trust professionals join our Midland team, and certainly excited to have those clients now become Midland clients. So I want to welcome all of our clients who are on the call today, but maybe a special welcome to those who were formerly ATG clients, now Midland clients, and welcome to your first Midland Wealth Management Mid-Year Outlook. With that, I'm gonna go ahead and start the presentation, and we're doing it maybe a little bit differently this year. We're gonna go ahead and work our way through a Q&A session with Betsy and Tracy fielding the questions. We will have a PowerPoint presentation that hopefully you'll be able to see on the screen here. These questions come to us from all of us who are interacting with you, our clients, on a daily basis, and so these are questions that we're hearing when we're having our client meetings, and fortunately able to get back to having face-to-face client meetings here in the second quarter. So that's a great thing. So that's where these questions are coming from. It's kind of what's top of mind out there and what we're hearing from an economic and a market standpoint. So with that, I think I'm going to go ahead and jump right in. We've got a lot of material here to cover, and we want to keep everyone on time here over their lunch hour and make sure we end up sharply at 1 o'clock. So first question, and it's in the news almost on a daily basis, right? Inflation. So Betsy, Betsy and Tracy, there's been a lot of talk about inflation. Seems like everything costs more these days. Where do we think inflation's headed? What do we think about it right now? And what about what the Fed's saying when they describe it as transitory?
Well, Eric, I'm going to start with this chart, which basically lays out where inflation's been for the last 50 years on a historical basis. So you can see that, back in the 70s, we had very high inflation. They fought it, brought it back around that 3.5% level for a long period of time. And for the last 20, 30 years, it's really been closer to that 2% target. And what we'll really say is that over the last 10 years, we haven't even been able to get above the 2% target for the Fed. And, the Fed has been trying to keep that going, and finally we're seeing the spike. So we did have an inflation number this morning that came out with the headline CPI at 5.4% year over year, and the core ex-food and energy up 4.5%. It was a little higher than was expected by the market, and a lot of it was driven. A third of it was used car prices, which are up 45% over the last 12 months. and as well as a substantial increase in hotel pricing, which is up about 8% for the month. So what we're seeing is a lot of things that had gotten almost deflationary a year ago are picking up off their lows from last May and June. And that's where the Fed's looking at it going, is this transitory, which is really, is it? We don't know. It's kind of the unknown. Some of the things that might lead you to believe that it's transitory is that, lumber is one of the things that spiked dramatically with, the mills have been shut down for 3 or 4 months. It got backlogged, and there was extensive building and housing and everywhere else, and it spiked dramatically higher. It is now down about 50% from its highs, but it's still higher than where it was, a year ago or the last 5-year average prior to a year ago. So that's one of the things we say, is it transitory? It's becoming more of a deflationary thing year over year, maybe over the next 12 months. Then you can look at, oil. Oil's up. But, if you looked at it, there's a downward trend line here, and we've spiked above that this time. We're closer to $74, $75 a barrel. On the WTI, the lows, we hit a low last year when there was no demand for oil at all, and part of that is, there's less supply, but some of that supply has picked up. OPEC has started pumping a little more. Our oil rig count is up, but inventories are down and they need to build those up. So how long will this oil price stay up there? It could be in this range for a while. But will it spike higher and be an inflationary thing? Because when we think about inflation, it's the price change from the previous month or the previous year. If we're seeing a spike up from the lows of last June, and now we're in June of this year where everything's picked up, does that inflation then a year from now spike as much? That's what the Fed is looking out for and saying, is it transitory? Is it just a recovery from where we were? And is it going to slow down going into 2022? One thing that is really the $64,000 question really is wages, because wages go right to the bottom line of a company, and are companies able to raise prices? Will wages continue to go up dramatically? When you look at the last month, this chart is from the breakdown of where inflation or the wage pressure came in the month of May. The biggest part of that came in the leisure and hospitality. But you have to think about it. A year ago now, there was no one working in those sectors. Now they're trying to find employees. Information technology had a pretty big spike, but the other one was retail. It's another one. No one was in stores. Stores were closed. You could only do pickup outside. So is that going to, as things even out, is it going to become less inflationary? That's the question. But the bigger problem we have right now is not having enough workers to fill the jobs. So there's several reasons for this. Right now we have job openings of over 9 million. We have unemployed of about 9 million. So it's about 1 to 1. So why are the jobs not getting filled with the number of unemployed? Some of the people may say, it's a myth that it's because we have these extended unemployment benefits, a number of those things, people haven't got back to work. It'll be interesting to see over the next 2 or 3 months, because many states have cut that in June, and we'll start seeing a pickup in people going back to work because the benefits are gone in July and August in those states. And then the final states will end up in September 6th. So by October, we should be able to see what the real impact of this was. While it may have some impact, it is not the full impact of why we have a mismatch of labor. We've also had people move. So people who lived in high-cost cities and were decided they didn't want to live there anymore, and they moved someplace else to work remotely, or they didn't need to work yet, those kind of things. Now there's a mismatch of labor with locations as well as skills to some extent. So we'll see how that plays out. But it's not the only reason why we're short of workers. What we're also seeing is, the 25 to 54-year-olds, they've, started participating back in the workforce from the high there. The 16 to 24 have really spiked back up to almost where they were pre-pandemic. The interesting part of this is that the 55 plus has actually declined. So what we've seen, and we all knew that the baby boomers at some point were going to be retiring, that they would be leaving the workforce. But I think the pandemic sped it up for people that aren't even in the baby boomer age, younger people. The markets have been wonderful. financial status was there. People realized going to work every day wasn't really what they wanted to do anymore. They could afford to retire, and they have just left the workforce. So we're missing people from that that may have typically have worked till 67 or 68 are now deciding in their late 50s and early 60s to just drop out of the workforce. So that's one part of it. Another part is we haven't really had immigration. So when you look at last year, of the first 2 months, you know, the immigration pool was open. We immigrated about 200,000 people last year. We typically immigrate about 1 million people to the workforce every year. So we missed 800,000 last year. We really haven't had much immigration yet this year. So you're looking for the first 6 months, we're probably already 500,000 to 600,000 behind. That's over 1 million workers that would typically join the workforce that we have not had available to us. And we need immigration because when you look at how our growth in our economy is, GDP is driven by the growth in the working age population, the number in the workforce, and productivity. If we cannot grow the working age population, we will not grow our economy. So once we open this all back up, which probably in the next 6 to 7 months, hopefully, we get back to a more normal environment with this kind of thing, this should even it out. But until then, it's going to be some pressure on who's available to work. Because we do need that, because if you look at the population, we have fewer available workers over the next 10 years to work. We have more people retiring in the 65 plus, and the number of people in the under 25 and the 25 to 65 pool will decline as well. So we are an aging population similar to Japan, which had some issues with some of their economy because they have a slow work for age group growing. So it's not only the unemployment, but it's also a number of other factors. As we look at that, it subsides, it may get back to a more normal level. But from an inflationary standpoint, is it transitory? That is yet to be seen. The Fed is watching it very closely. Many of these things are one-time hits. It may happen over a 3 or 4 month period coming off the lows, but is it sustainable when we move closer to that 2 to 2.5% on a longer-term basis? And the Fed believes that's what's going to happen and are monitoring it very closely. So inflation, yes, we're going to see spikes this year. It'll be interesting how it flows into 2022. Eric, next question?
Yeah, similar type theme, Betsy. When you think inflation, you think, a lot of people think interest rates, right? And for a while there, interest rates continued to climb, and now we've recently seen a backtracking of that. The 10-year Treasury was as low as 1.25%. I think today it's somewhere in the neighborhood of 1.35, and that's coming off the highs of 1.75%. So what's going on with interest rates? Why the decline?
Okay, so one of the things that's happening is a mismatch of supply and demand with the bond market. Part of it was technical issues to get it to 1.25, but really the supply-demand issue has been the driving factor. So last year at this time, the Treasury issued a substantial number of bills and notes and increased their cash balance so they'd have enough to function and they would keep the money flowing, right? They had all that excess cash and they've been letting it run down and they haven't needed to issue much. So if you see here, you have the spike up in mid-2020 and they've really just let it run down without having to, really raise debt. So when you look at the next chart, you can see that this is a Treasury issuance. This is last summer, which shows the huge increase in the cash supply. But the net borrowing has been negative. So with that, you have the supply-demand issue. The more supply, the less supply, and you have higher demand, it leads to lower rates or higher prices. In bonds, prices go up, rates go down. So as this cash balance is depleted, there'll be more issuance that will be necessary, which will lead to more supply, which could eventually put some pressure on rates. In addition, we have had the Federal Reserve buying $120 billion in bonds, with I believe $80 billion of that coming from treasuries every month. So that's, once again, supply-demand issue. You look at it and you wonder, okay, greater supply, not there. We need more supply to meet up with that demand if we want to keep rates at the level they were. So that all feeds into it. In addition, we've had global interest rates decline. Treasuries appear more attractive on a yield basis. also a phenomenon that happens when interest rates decline. Mortgage prepayments typically speed up with refinancings and a number of other reasons. And as prepayments speed up, the average maturity or average life of that mortgage falls. And if a bond manager is running a pool of money, wants to maintain their target maturity, they have to buy longer term bonds to extend it back to the point that they want. So once again, there's more demand and we've had less supply. The other thing that's gone on is we've had this wonderful equity market where everyone has made money, but with that, our asset allocation targets have gotten out of whack. So people have had to rebalance, pension funds have had to rebalance, money managers across the globe have rebalanced, so they're selling stocks and they're buying bonds. Once again, supply versus demand. And then in addition, there's also always seasonality in the market, which typically results in a strong bond market in the summer with falling rates. It's just the nature of the beast. How much of it is this, I don't know, but it's part of the reasons why rates have fallen. Another reason why the rates have fallen, and probably the most recent thing, is that at the last Fed meeting, market participants actually believe that the Federal Reserve is discussing how to begin to end the excessively accommodative stance through tapering their bond purchases and the eventual short-term rate increases. They did take an action to raise the overnight rate for bank deposits for banks at the Fed, which was the first action which allows more money to stay there and take some money out of the system. So the market is giving the Fed time to determine if inflation is transitory and believes it will respond accordingly, and therefore they don't think there'll be upside risk to interest rates. So, a number of those factors really have come into play, and it's driven interest rates lower. Now, if the Fed begins to taper, or there's less, there's more supply out there, we could see pressure on interest rates over the next 6 to 12 months. And we would believe that we're probably near the lows of the cycle. The 175, is that attainable again by year end? It is possible, but there'll be a number of factors that will go into that to get it there. And one of them will be believing if the Fed is really doing the right action or if they think they're behind the 8 ball.
Excellent. So another question that we've been hearing a lot of from our clients is in regards to the debt level, government spending, the multiple stimulus packages over the last 18 to 24 months, infrastructure package being discussed now and have been for several months. So government spending way up, and that's obviously increased the debt levels. So, what are our thoughts on that? Or how would that potentially impact future growth?
I didn't even talk about the debt level, but the COVID relief stimulus, I think you always have to look at this and go like, we have put a huge amount of debt out there. $5.7 trillion of debt over the last year. That's in addition to the monthly bond purchases by the Federal Reserve. There's a lot of money in the system and a lot of debt was taken on by the government to do this. Granted, they haven't issued it in supply, but it's debt that's outstanding and they're finding ways to do it. So with that, you have to look at it and wonder, what's going on. But if you look at corporations and households, so you look at the blue lines in this chart, household debt is low. It's back for almost to the levels we saw in the recession of the early 2000s. It is very low. The leveraged position they took to get us into the financial crisis, that was a spike, but they've come back and they've really allowed themselves, households, to become much more flexible, have some fiscal independence. Corporations, in turn, have also low. They have done some issuance in the last year because debt's cheap. Let's take the debt on now so they can cover it. And, while it's a spike in where they were, they also did it at very low rates and locked in cash to be able to have flexibility in the future. So as long as interest rates remain low, corporations will be in very good shape, and so will the households. It's the government that's really extended the debt level. And as long as rates stay this low, the cost to service it remains manageable. But what happens if interest rates spike? That is the question. And will it take away from growth in the future? With all the stimulus we've had and everything, it could take away. And this is a chart that JP Morgan has actually put together. They believe that we've had so much fiscal stimulus to spur the economic growth, that in next year, it'll actually be a negative impact on growth. And that debt taking on will take away from the growth factor. And, whether this is true, this is JP Morgan's impact or not, you got to think that in 2022, the government is not going to stimulate the economy, but they will continue to have their debt to cover. And debt isn't a good thing, but it will be a drag. The government will become a drag on the economy with their cash flows, which is will be the first time in a couple of years that that's really happened. And what will happen is we'll get back to a trend growth. We've had pretty spiky growth in the last 12 months from the lows of the second quarter of last year. You can see we were, the GDP growth, this is in dollars based on 2012. We had this huge spike down. I think we were down 35 or 40% in GDP in those 2 quarters. We've had a spike up. This is through the first quarter of 2021. You have to imagine the second quarter is going to be somewhere around 7 to 8% at a minimum in growth, in the third quarter as well. We'll get back to trend line growth. And will we be able to keep that growth going? And will the government have to issue more debt to keep going? Will there be more stimulus? I think the debt does become a problem if rates go up. And that's what the Fed is also watching. I mean, I hate to say it, but they have some political reasoning to not raise rates dramatically because it becomes a bigger burden to the government to have rates higher. And so they're monitoring that closely and don't want to overdo it. Also, if the Fed would by chance tighten too quickly and throw us into a recession, it lowers the tax receipts for the government, which then the debt level does become a bigger issue. So I think we'll probably move back to more long-term trend growth. And hopefully with the rates maintaining at fairly low levels, not the levels we're at today, but maybe that 2% on the 10-year, 2.25%. The government can still logically pay their interest and have it not be an entire burden to the growth cycle.
Right. So we're going to switch gears here a little bit and talk a little bit about the market. But before I do that, I should have mentioned this at the outset. Obviously, these questions we've got prepared here are coming from our clients that we're talking to on a daily basis. But for those of you on the call, if you would happen to have a question, if this spurs a question in your mind, if you came into the session with a question in mind, please go ahead at the bottom of your screen. For those of you familiar with WebEx, there's a little chat button there, and we'll be monitoring that. So if you do have a question, type that into the chat button, and hopefully we'll have time here at the end of the presentation to answer those questions. Or if folks want to jump on the call, jump on the line and actually ask a question at the end of the session. So with that, like I said, we're going to switch gears a little bit, and we're going to talk about the market and give Tracy a chance here. So Tracy, we've seen some phenomenal returns here over the last 12 months. S&P 500 up north of 40% as of the beginning of this week, I think, over the last year. Can that continue? Is there more upside, or are we due for a decline? What are our thoughts on that?
Yeah, and as I was thinking about my comments here, I'm going to transition as to what Betsy was saying that she really hit on, liquidity and stimulus. That has been a big factor in the upward movement of the stock market and the recovery that we have seen over the last year. So that has probably propelled this recovery higher and quicker than any bear market I think that we've seen in history, actually. So that has a big is a big factor as to why this market has moved as it has moved. And the question on valuation, I am getting this from every one of my clients, that this has to be over, it can't keep doing this. I think the first thing that the last year has probably taught us and showed us is that valuations are a very poor market timer. And historically, that's been the case. Market valuations have not been useful in timing the stock market, either peaks or troughs. And I think one thing that comes into play that we kind of saw last year and this year is valuations even become less useful at the end of a bear market and at the beginning of a bull market. Because at the end of a bear market, your earnings are about as bad as they can get. So your valuations are looking just astronomically high. And then even at the beginning of a bull market, it's the same thing. You don't have the earnings built in until after the initial move. So valuations become a very poor market timing decision. I think going forward here, what we really want to concentrate on is what is the monetary and fiscal stance within the government, within the economy. And there's an old saying, don't fight the Fed. Well, we have a very accommodative Federal Reserve right now. I think as Betsy said, the markets are kind of giving the Fed the benefit of the doubt. Let's see if this is transitory, the inflation is transitory or not. And I think it needs to be recognized, too, that stocks actually do very well with moderate inflation. Unlike bonds, stocks perform pretty well in an inflationary environment as long as it's perceived that the Federal Reserve isn't way behind the curve. So don't fight the Fed. Very accommodative fiscal policy. Now, we do think that's one thing going forward, the end of this year and the next year, we're going to have to recognize is that some of the stimulus and the liquidity and stimulus is going to go away. We're not going to do another we're not going to do another $5 trillion of stimulus. So that is going to put a little bit of maybe a reality check into the market at some point. But right now, you got a very accommodative Fed. And the other thing we talk about more on a technical basis with the market is the trend is your friend. The stock market trend is very bullish and very positive right now. We get pullbacks from time to time, but the trend is still positive. And I always put up, and everybody wants to look at this chart, wants to look at current PE multiple. Our current PE is around 21, maybe a little bit, around 21 times earnings. It has come down a little bit from the high, but we're still at a very high PE multiple. And I know the clients I'm talking to keep asking me, what is the difference between today and 99 and 2000? And I think what we have to remember is back in the tech bubble of 99 and 2000, number one, 99, 2000 was the peak of earnings before we saw a dramatic deceleration, decline in earnings growth. It was the end of the cyclical bull market. Also, the Federal Reserve had already started raising interest rates in the end of 1997. So we already had an aggressive Fed beginning to tighten. And compared to today, we are just recovering from very, very poor earnings deceleration last year. Good, strong earnings growth, which is not going to go away. For the most part, and I'll flip to our next page, we're seeing earnings growth year over year at 56% from last year to this year. Very, very strong earnings growth. The only higher earnings growth we saw was at the end of the global financial crisis that we had. Margins have been very, very strong. Now, we did make a note here. Inflation will cut into profit margins of some companies, but we want to focus on the companies that are actually going to be able to maintain their profit margins or increase profit margins in this type of a scenario. And I'll throw out technology as one area that will very possibly still be able to maintain those very strong profit margins. So, to think this is over, we don't believe that's the case. And if you go back to 99, 2000, 47% earnings growth off the bottom, but 15% earnings growth a year later. We could easily still see 15 to 20% earnings growth year over year, the end of this year and the next year. So although earnings growth is going to slow down, and you would have to expect it's got to slow down, you're still going to have very, very strong earnings growth going into next year. And probably 20%, maybe even a little bit higher, the second half this year and the next year. So just to think that this quarter will probably be the peak in earnings growth. As we said, as good as it gets. but we're still going to see very strong earnings growth with what we still see as a very accommodative Federal Reserve and continue to see monetary policy very favorable. And I haven't even gotten into the scenario about the global recovery and the reopening. I know we'll talk about some headwinds later, but overall, we still are seeing, we're still in the early phases of the reopening, both in the U.S. and globally. So we still think earnings are going to be very strong for most companies. Not to say we don't have some speculation in the market overall in certain areas of the market, but overall profits and earnings are still going to be pretty solid. One thing, as we look at valuations, you know, PE multiple is one thing, but I think also, you know, stocks tend to get ahead of themselves. And, you know, if we look at it today, you know, is the market overvalued? You know, you might argue it's ahead of itself, at least near term. Maybe we need to consolidate some of these gains. Maybe we need to have a correction, and we've been talking about it, quite frankly. You know, we would welcome a 5 to 7% correction, maybe even a 10% correction. Those are all realistic things to expect. You know, any given year, you usually are going to get 2 to 3, 5% corrections a year. You know, you're usually going to get 1 or 2 10% corrections a year. We really haven't had one yet. I think we had a 4% correction in February. So it would not be out of the scheme of things to have a correction here in a consolidation. We actually think that the markets have actually had a rotating correction all year. January, February, into March, we saw technology stocks perform very poorly. Money rotated out of technology and growth into value, into financials and industrials, energy, basic materials. We then saw real estate start to perform better here in April and May. And unbelievably, June saw a very strong rotation back into technology and out of financials and some of those value stocks, industrials and financials. So we think there's already been in the underlying market, has already been a rotating correction between sectors. So some of these sectors are not as overly ahead of themselves as they were 2 or 3 months ago. But I think we do have to realize that the markets get to extremes, and sometimes when you get extreme optimism, you've got to have some consolidation or correction to kind of get back to a more neutral stance. And one thing we look at is this chart here, real earnings. And these are real GAAP earnings. So basically, what is the earnings yield of the S&P 500? And instead of the P/E ratio, price over earnings, we simply take earnings of the S&P divided by the price of the S&P 500 index. And as I said, these are real GAAP earnings. And if you take that and divide it, and you get about a 5.5% earnings yield, well, actually at this point, it's less than that. It's probably 2%. And you subtract inflation, you're actually at a negative earnings yield. The current earnings yield is less inflation is about a negative 2.8%. And the same is true at the bond market. If you take a 1.3% 10-year Treasury and subtract, you know, 2% inflation, or actually this month was 5%, you've got a negative 3+% real earnings yield. So these, over time, are not great instances within the market. And what it tells us, either the outlook is too optimistic, or we just we need to have some consolidation, whether it's the price of the underlying asset coming down, such as the S&P 500 having a correction, or we need stronger earnings growth going forward. And we still think we will get pretty strong earnings. But I think it's important to realize when you get in this, we kind of drew this, I don't think it's pink, I think it's, Magenta, there you go. Betsy says magenta. But this dotted line is really, you get below 1%, negative 0.8 real earnings yield. Stocks tend to not perform as well. So, we would expect some consolidation in this market and maybe some pullback. It just is an indicator we look at that shows that this market is probably somewhat overbought right now, particularly with some of the headwinds that we could see the second half of the year. So we would expect more volatility in this market as we move forward. A couple other things I think on the investor sentiment horizon that we probably need to be aware of is the Vix Index, the S&P 500 Volatility Index. It's gotten very complacent recently. We're down at this 15 level. Again, between the two dotted magenta lines I put in here is kind of a normal long-term trend. So we're kind of the middle of that range. Now, nothing says we couldn't get much more complacent down to 10 or 12, and we have sat down at 10 or 12 VIX reading for a pretty good length of time. But historically, we usually will see volatility increase here. So again, we would expect some more volatility in the market, which could lead to somewhat of an overdue correction. Whether that would be 5 to 7 to 10%, nobody knows that, but it would be a reasonable expectation to see a correction here. But volatility is very complacent, and it seems like there's an awful lot of good news priced into this market already. So I think a little bit of caution is warranted. We pulled back a little bit in May and took a little bit of our overweight off the table. So would not expect some type of a pullback here. Couple other sentiment indicators I think are very important. This particular indicator, the American Association of Individual Investors, this is a sentiment indicator, and of course it would run contrarian. So when you have excessive bullishness, excessive optimism as we have right now, signified by that red circle, this gets into the excessive bullishness range, which historically has been followed by some degree of pessimism that maybe this is a little bit overdone on the upside. So again, it's another indicator. We're at levels that we haven't seen really since early 2018 for the most part. So another indicator that some pullback is probably to be expected. Once you get excessive bullishness, most people are fully invested. There's just not a lot of money on the side to continue buying stocks. So that's kind of what the contrarian strategy is here. And then, of course, if it drops down below this lower magenta line, becomes probably more of a buying opportunity. So again, expect some pullback. Probably not a double-digit type correction. We don't think that's in the cards with the amount of fiscal and monetary stimulus. Another thing we look at is the retail investor. And this particular chart I think is very interesting. I've followed this for quite some time from Ned Davis Research, is when the percent of stock holdings as equity holdings as a percent of household financial assets becomes extremely high. That is usually a bearish sign that maybe investors are overbought in the stock market. It tends to be kind of an indicator that, again, there's not a lot of money on the sideline to continue buying stocks. Investors are pretty fully invested. And again, the highest level, higher than what we saw in 99 and 2000. Now, I will say something here that maybe there's something that needs to be considered here in today's environment, is that bond yields, money market yields are making next to nothing. So there's no sense holding a lot of cash. Bond yields are very, very low, with bond yields beginning to go up. And if bond yields go higher, prices go down. So, year to date, bonds are flat to negative. So there hasn't been a lot of places for investors to go. So I think they have been forced into the stock market. And remember, moderate inflation is actually good for stocks. So in this environment, stocks will probably continue to do fairly well as investors become more concerned about their bond holdings. So again, probably need a pullback, but there might be a reason that these investors are holding more in equity than fixed income. A couple things we do want to be cognizant of is, speculation in the market. Again, we don't see this market as a 99-2000 tech bubble. Those of us who went through that, there were companies that had no earnings selling at 60 and 70 times revenue. Even companies who did have earnings were selling at PEs of 80 to 120. Qualcomm was selling at 120 PE at one point. Cisco Systems was selling at a 70 to 80 PE. We don't have those type of numbers on your high quality, what I call your high quality blue chip tech companies. And aside from that, there's still some very attractive valuations in the S&P 500 today. So financial stocks are still very attractively valued. But there are some signs of speculation, I think, that we have to keep in mind. And this goes back to our outlook that maybe it's as good as it gets. Initial public offerings and secondary stock offerings have increased dramatically. So companies that already sell publicly are doing a secondary stock offering in order to generate more capital. There's talk that maybe AMC or GameStop should issue new stock and use their high price as a currency to issue more stock and increase capital. But we're definitely seeing companies take advantage of the upward move in the stock market to do this. Also initial public offerings, the highest level we've seen since, again, the tech bubble. But again, companies that are private, that want to go public, you want to do it when the getting's good. And we kind of think that might be where we're at right now. And to us, it is another sign that maybe this market is getting a little bit ahead of itself and potentially a correction may be in the cards here at some point. And the other point I want to make here, Betsy brought this up as we were talking about things yesterday. We do have fewer stocks out there. It used to be the total U.S. stock market, large, mid, small, was over 8,000 companies. It is now under 6,000, about 5,900 and some odd companies. So there's less stocks, more money chasing less stocks. So that may have something to do with this, and may have something to do with the favorability of these initial public offerings. But I do think it is a sign that a little bit of over speculation going on here. And I always put something we look at, and we put here, this is Betsy's EKG. No, but it seems like there's a lot involved in this chart, but really it is a very, very simple chart. And it's something that I monitor really weekly on a technical basis, and it's called market breadth. And simply what market breadth is how many stocks in the stock market are participating in this bull market. And it's easy to say, for an ongoing bull market to continue, we need to have broad participation from all asset areas of the stock market. All large cap stocks, mid cap stocks, small cap stocks. We need growth. We need value. We don't need just tech. We don't need just financials. We want all of them to participate. And when you got strong and very healthy market breadth, the longer-term bull markets can continue for an extended periods of time. So what this shows, and this is only looking at the stocks within this the broad market, mid-cap, large cap, mid-cap, small cap, and looking at those stocks that are either above or below their 50-day moving averages. So as you would expect, they change, this percent changes every day. But right now, we're only at about 44% of stocks in large, mid, and small and U.S. market that are above the 50-day moving average. Now, what it says is it's still within a neutral zone. Those dotted blue lines going left to right is kind of a normal zone. It's in the middle of that zone, so it's not something that we need to be overly concerned about. But when a market is healthy and a bull market's healthy, you can see, we earlier this year, we spiked at almost 78. Last November, we spiked at 87. So a little weaker breath. We would like to see the market breadth continue to improve from here or hold steady. So we don't want to see a big breakdown in market breadth and momentum. We don't believe we're there, but it is something we want to monitor. So market breadth is very, very important for this continuing bull market. And I kind of have sort of an economic chart, but I put it in equity because I think it's really important. And it gets back to the inflation theme that Betsy was talking about. And if you look at the M2 money supply that has skyrocketed here, as this money supply has skyrocketed, what's happened? Stocks have performed very well. Liquidity has found its way into the stock market. And what we look at, we would expect CPI, the Consumer Price Index, should follow this. And you can see it is up from the bottom that we were at of last year and this year, but it hasn't really broke out on the upside to follow that money supply. So will it actually break up? And we will probably see it move higher. But what this did when we were looking at this, it brought into play another big question. Is there a secular change with inflation? And as the Fed says inflation's transitory, you know what? Maybe they're right. If you look at this, and we tried to look and see when did the money supply and inflation really begin to become negatively correlated? And it was really in the early 1990s, kind of moving my cursor here, sort of where I started drawing that blue channel. And that is when we had globalization, China, Japan. It really became a global economy, a global market. What that brings is competition. It brings lower prices, along with that, lower inflation. Also technology. Huge increase in, technological revolution that it has been a big benefactor and helped productivity. And we think these are ongoing. So until this trend changes, the Fed might be right. It may be transitory. So it's something we have to keep an eye on it, but we expect CPI to go up, but the question is how much, and maybe it isn't going to be as big a factor. It may just be moderate inflation, which actually would be good for stocks. We just don't want the Fed to get behind the curve where they would have to really slam on the brakes. And at this point, we don't think it's there, but we do think they probably need to, take some of the stimulus away. And the last two things, this one goes hand in hand with this chart right here, stimulus. So we had the big growth in money supply, as we see by this chart. However, if you look at what we call the velocity of money, it has not picked up. It's still sitting at very, very low levels. And the big reason is the lack of credit creation. Banks have taken in huge amounts of deposits, and the demand for lending really hasn't increased all that much. And we do think there's going to be a big pent-up demand for borrowing, and that will help banks, that will help their profits. But this could be something that is keeping inflation in check also right now. And without further stimulus, this lack of money supply growth, we may start to see the credit cycle start to take off here. But this is probably another reason inflation stayed in check. And the last point I will make, and this is not a great chart. It doesn't look really good. It came from a service we have subscribed to, 361 Capital, but I think this is a great chart. And I got to admit, I did not know that this differential was this high. But if you look at the amount of money that has flowed into the bond market and stock market, and that being bond ETFs and mutual funds and stock ETF and mutual funds, since the global financial crisis of 08 and 09, we have had a huge amount of money, that's the yellow, flow into the bond market. Why was that? Because the Fed made it very clear they were going to keep interest rates near zero and lower interest rates and do quantitative easing, and bond investors feel, you know, I'm not going to lose any money in the bond market. However, if you look at stock flows, it kind of picked up, but it hasn't been anywhere near what we saw in the bond market. So the point to be made here is that we may be right at the beginning of a fairly significant rotation from bonds into stocks. And that could help propel this bull market, continuing to propel it going higher. Bond outlook is not good. Many people have never lost money in the bond market that have been invested, but that could easily change here as interest rates go higher. So something to keep an eye on, that we may have seen stock flows increase and may continue to see them increase going forward. So we still remain slightly overweight stocks, would expect some type of a pullback maybe, but earnings are still going to be solid going into the rest of this year.
Okay. Excellent. Thank you, Tracy. So we talked about a lot of positives there, and as Tracy just mentioned, we're currently overweight stocks, although we do potentially anticipate a little bit of a correction. So a lot of good things happening out there, but there's always headwinds, right? So maybe in the time we have remaining, Betsy and Tracy, can you talk a little bit about some of the things that are on our radar that could potentially derail some of the positives that we talked about?
Yeah, I think the big thing out there is this new variant of COVID, the Delta, that the people who aren't vaccinated, and globally, is it going to slow down the economy again? Is it going to overtake in the fall? As we've opened up and more people are getting exposed, I just saw that Illinois actually closed down travelers back from Missouri and Arkansas. If you're unvaccinated, you need to go into quarantine. So, the South is really seeing it. I think Arkansas, Alabama, Missouri, places where there's been less vaccinations. So I think that's it. And it's not only here, it's globally. When you look at, Europe is starting to recover, and some of the other countries, Australia, and they've had some issues. So I think we have to continue to monitor that for the growth. Yep. The other thing I think we really have to monitor, and we can't make any decisions, but what impact will be if there is any tax law legislation that goes through. At this point, if it does get passed this year, it'll probably become effective January 1st. But what will happen? Will they increase the capital gains tax? If you do that, do you see a sell-off in the market as people take some of those capital gains this year at a lower tax? If they take away this step up in your estate value, what impact does that have? Do people start selling some of those securities? Because a lot of people have held on to high price, low cost equities or investments because they think they're closer to death than they maybe actually are, but they wait for that step up so they don't have to pay the tax implication. So there's always that thing to watch. Geopolitical, Tracy and I were talking, China is not our friend again. They're, limiting, the amount of, they don't want their companies to issue ADRs in the U.S. They're limiting that. They want to become more inclusive in their own country, exclusive actually more. But, and they've had some slowing in their economy. They're lowering rates, making credit more available again. What's going to happen? I think there's been some issues in the Middle East again. Those are the geopolitical concerns. We don't make decisions on those necessarily, but you have to be aware of them. And then, we aren't going to have the stimulus that we've had. And what impact is that going to have? I think I presented earlier, it's going to slow down the economy when we don't have all this money coming into people's pocketbooks. They're going to have to go back to work, and they probably won't make as much at work when they pay taxes as they might have on the stimulus. So, there are some things to really think about. And we're cautiously, watching these. As, Tracy said, we're cautiously optimistic. Things can have a correction, but we would still favor stocks over bonds over the long term. And it's kind of interesting, just while this presentation was going on, they did the 30-year Treasury and auction today, and it went poorly, so the 10-year has actually gone up 5 basis points today. So it's gone from 135 to 140. So the market's fickle, and we do think that rates are probably near the low end. Doesn't mean they can't stay there for a while, but there's probably more options in the equity market, but no, there's headwinds we have to watch out for. Are there any questions in the chat box?
I did not see any, Betsy.
Okay.
I missed any. I don't know if anyone on the line. Yes, if anyone on the line wants to unmute and ask a question, we've got a few minutes here left. Okay, well, if not, appreciate again everyone's time this afternoon. Hope you found this to be informative. We will do this again at the end of the year. In the meantime, please follow us on LinkedIn. We put regular updates out there on LinkedIn, not only about the markets and the economy, but what's going on within Midland Wealth Management. Obviously, we do a quarterly newsletter and we do monthly updates as well. And you can find all that good information on LinkedIn as well as on our website, midlandsb.com. So thank you again for your time this afternoon. We very much appreciate your trust and your in terms of you as a client, we very much appreciate that you've given us the opportunity. Your trust and your confidence is the word I was trying to say that completely blanked there for a minute. But again, thank you everyone for your time. We look forward to talking to you soon. Have a great day.
Thank you.